Okay, how often have you gone into a trade expecting one thing, but the market does the exact opposite? It can be quite frustrating if this happens over and over and over again. But did you know you don't have to get stopped out for a loss if the market doesn't do exactly what you thought? Once you've learned the options technique in this video, you'll know how to turn a frustrating losing trade into a winning trade. Winning trades feel much better. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. We hope you agree this is the top YouTube channel to help you grow your trading account.
Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And one of the most significant developments in the financial markets this decade is the explosion in popularity of trading options on the day that those same options expire. In other words, trading the final day in the life of an options contract. And that's because the options market has introduced daily expirations for a few options products, what are known as zero DTE options, which stands for 0 days to expiration, because at the end of the day, zero DTE options will expire and cease to be traded. And the big change is that for NDX, SPX, XSP, SPY, and the Qs, the options market publishes options chains for every trading day of the year, whereas in the distant past, options chains, believe it or not, were only available once a month. And as a result, traders are now in the position of being able to develop strategies to trade options on the day that they expire every single trading day of the year without having any overnight exposure, which traders consider to be a big advantage. One of the most popular strategies for zero DTE options traders is known as the Iron Condor. And in this video, we're going to be exploring how to manage an Iron Condor trade, which expires the same day that it was entered. And in order to explain how this strategy works, we need to make sure that you understand how index options work. Now, if you're new to options trading and don't know what index options are or how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen now, it will lay the groundwork for understanding the strategy we'll be teaching you in the video. Then when you're finished, you can come back and watch the rest of the video. Let's show you how an Iron Condor works, and then we'll run through an example of how it can be modified to turn it into a winner if the trade was going against you. So let's head back to last week, and as you can see, the index over the past week was trading in a tight 90-point range between 44.60 and 45.50. And so when options traders see this kind of a tight trading range, which is going to happen incidentally in low volume summer trading environments, they consider this to be an ideal time to implement a one-day Iron Condor trade where if the market continues to trend in that general range, the trade should win. Okay, so on the morning of August 10th, the market opened up at 45.03, which is just about the middle of that trading range. So suppose that we had pulled up an options chain for SPX that day, and we went ahead and sold 10 calls near the top of the trading range up at 45.40, which is about 40 points above the opening SPX price, and also sold 10 puts at the bottom of that range at the 44.60 strike price, which is about 40 points below the opening price for options expiring that day. And then for protection, we moved up 25 further points to the 45.65 calls and down 25 points to the 44.35 puts and went ahead and bought 10 of each of those. So this structure, this sequence of short calls above and short puts below, straddling the index's price, flanked by long calls and put options farther away from the market, this entire structure is what is known as an Iron Condor to options traders. So let's first take a look at the cash flow implications of this trade so you can understand how this trade will affect the cash flow in your trading account. So starting with the short 45.40 calls that we sold for $1.25, you'll remember that each index option pays off $100 per point beyond the strike price of the option. So you multiply that price by 100, and we sold 10 of them, which results in total cash inflow from selling the calls of $1,250. And we also simultaneously sold the 4450 puts for $1.80 for a cash inflow of $1,800, as you can see from the calculation. And then simultaneously, we bought 10 of the 4565 calls for $220, while at the same time buying the 3435 puts for $650. So when you net everything down, you end up with positive cash flow of $2,180, which gets deposited by your broker immediately into your account. The amount your broker will require for this trade is $22,820, which, by the way, is the worst case scenario on the trade. And so that's the amount of capital you'd be putting to work to enter this trade in this size, which you need to know if you would ever decide to entertain a strategy like this. Of course, if you have less capital in your account, you just reduce the size of the trade to fit your account size. Okay, so now let's move forward to 1 p.m. that day. And as you can see, the index, after initially rallying, sold off by 44.75 by 1 p.m., which is more than a 25-point drop. And remember, if the index closes below 44.60, where the short puts are, they will be paying off $100 per point for every point below that. And we sold 10 of them, so we'll be paying $1,000 per point out of the initial $2,180 that we collected. And so in this kind of case, most traders concerned that if the market goes any further, those short puts are going to be breached, they will execute what options traders refer to as a roll of these short puts and the long puts downward 10 points. So in this case, the short puts at 44.60 are moved down to 44.50, and the long puts at 44.35 are moved down to 44.25. So to accomplish this, we just close the original position, buying back the short puts and selling the long puts and reestablishing the short puts at 44.50 and relocating the long puts to 44.25. So what we've just done is created a 25-point gap between where the market's trading now and those short puts, which would feel a lot safer given how the market was trading that day. And so when the roll is completed, the position looks like this, with the old put position gone and the new put position reestablished 10 points lower in both the short and the long cases. Let's take a look at what has just happened to our cash flow in the process. And as you can see, we paid $4,600 to buy back the 44.60 puts, and we received cash of $1,180 for selling the long puts at 44.35. And then reestablishing the position, we sold the 10 44.50 puts for a total cash flow of $26.50. And finally, we repositioned the protective long puts to 44.25, paying $7.30 for those puts, resulting in a net cash outflow of $1,500, which, when you subtract that from the original cash flow we received for selling the Iron Condor in the first place, it results in remaining positive cash flow of $680. Now let's move to the end of the day on August 10th, and as you can see, the index closed down a little further at 44.6883. And so when an option expires, which happens every day when a 0 DTE option expires, then the option is settled, and with options, it's binary. The option either closes in the money, in which case it has value, or it closes out of the money, in which case it has no value. And so with the index closing at 44.6883, which is a price that is between the strike prices of both the call positions and the put positions, let's take a look at each of the options which comprise the final position that we adjusted into. And as you can see, this is a pretty easy analysis because the two call options, the short and long options that comprise the call side of the trade, both expired well above the index closing price, so they expire with no value. And the put options also expire worthless for the opposite reason, which is that they expired well below where the market closed. And so as a result, all four options expired worthless, resulting in the profit on the trade simply being the cash flow left over from the adjustment which is that $680. And so what I'd like you to take away from today's video is that you don't have to be a sitting duck waiting for the market to close above short calls that you've sold or below short puts that you've sold as part of an iron condor trade. Rather, you can manage the trade by rolling the threatened side of the iron condor, which we did in this case on the put side, pushing the short strikes, which are your danger point on the trade, farther away from the market, assuring you that they don't expire in the money, which is how you lose on an iron condor trade. By aggressively managing your trade, you can take a trade that could have become a loss and make it a much safer trade by pushing the threatened side of the iron condor so far from the market that it's unlikely to close at a loss. Instead, you can turn a trade that could have been headed into the loss column and close it in the win column. I always tell the traders on our trade desk here that trade adjustments such as rolling an iron condor out of trouble are what separates professional traders from amateurs. And now you've got the knowledge of a pro trader who knows how to manage the risk on his trades, driving them to victory in many cases, as opposed to simply accepting a high-risk situation, which will result in many cases in a trade loss. There's a risk management technique for every option strategy, and professional traders carefully study those techniques to protect their trading account and improve their win rate substantially.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we've found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with S&B to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.